Hey folks, Dan Frio here with breaking news from the Fed, so let's get over to it.
Statement and the decision, and for that we go to Steve Leisman.
The Federal Reserve leaving interest rates unchanged at 5.25% to 5.5%, a unanimous decision in the December meeting. The Fed says growth has slowed from the strong third quarter pace, saying inflation has eased over the past year, but remains elevated. It's the first time they said anything positive about inflation for a very long time in the statement. And they backed off somewhat their bias to hike, saying it was now determining the extent of any additional policy firming, inserting the word any into the statement for the first time. They lowered their 2024 Fed funds outlook to 4.6% from 5.1%, so half a point down, forecasting on average for a Fed official 80 basis points of rate cuts next year. It had forecast just 50 basis points from a higher level. Of course, they got rid of the expectation for the forecast for an additional rate hike this year. That's gone. They lowered their inflation outlook for this year to 3.2 from 3.7 for core PCE. That's down by 50 basis points. They hit their 2% inflation target now, maybe a little bit earlier, sort of towards 2025 or the end of 2025. And they see below trend growth of 1.4% next year, a tenth less than the September forecast. Unemployment rate seen at 4.1 next year, about 0.4 higher than the September forecast. And they repeat in the statement that job gains have moderated but remain strong. Now, there's something in the dot plot that I think is worth pointing out. While that median did come down from 5.1 to 4.6, there are 5 Fed officials who are below that 4.6 number who see a full 100 basis points of rate cuts next year, and they're even more dovish into 2025. If you remember, the September forecast, there had been at least one Fed official who was above 6%. That's gone, and the top of the dot plot now for next year is now 5.40. So I would say that the Federal Reserve today took a step towards the market rather than the market taking a step towards the Fed. I wouldn't say it's an all clear on this, but the Fed definitely backing off plans to hike additionally, or making certain that it plans to hike, and also forecasting more in the way of rate cuts next year for the average Fed official than they had in September. Tyler?
And we are seeing, Steve, about the clearest market reaction we've seen to a meeting in some time, with stocks shooting higher. Dow's up about 150 points right now. And the 10-year yield just sank, at least almost 10 basis points. 13, you can see 4.07 is the intraday. On that note, let's get over to Rick Santelli for some reaction here. Rick?
Yes, 415 is where we were right before the number came out. We're at 406, 407. Obviously, we've been down rather aggressively. The drop 2-year note yields getting down to a 453 level. They were around 467, so about 13, 14 basis point drop. I think what is noteworthy here is if you look at the PPI in particular today, there's very little doubt that we see inflation showing. And the new game in town is to, of course, look at the current monthly rates and annualize them over 3 and 6 months. And if you pick the right inflation indicator, maybe the Fed's favorite PCE, yes, you can play with this data and get it very close to the Fed's objective. Well, that's all fine and dandy, and I do think that will afford them the ability to come somewhere between the market, 80 basis points, 110 basis points, whatever easing many see. And it is an election year, and it certainly seems to be baked in the cake. The problem is that as we look forward through the windshield with these annualized, very specific inflation metrics, the real issue for Main Street America is the windshield looks optimistic because all the inflation's embedded in the rearview mirror. We have compounded and solidified many of the price increases in the system. Moving forward, that rate of increase might move to zero and afford the Fed the ability to slow it down. But I continue to think of things like the Writers Guild strike, the auto workers up 25% over 4 years, Vegas casino workers first year, 11.3% increase, airline pilots, 34 to 40% increase. If we look at what's going on with UPS, 170 grand a year with benefits and pay increases. The reason I mention this is those obviously are in the rearview mirror as well, but they have set up a footing of pricing issues that will continue to hurt the market with regard to more workers, of course, and I'm not saying it's a bad thing, but there's going to be ongoing pressure for many others to continue to boost pay, and I think that cycle isn't going to be going away as quickly, even though the Fed will have the ability to lower rates in the future.
So that sounds like a repeat of what I've been telling you guys for the last 3 to 6 months. So I just wanted you guys to let you guys know the Federal Reserve did not change rates, but their outlook going to the future is lower rates by between 0.8 on the rates and 100 basis points, which is 1 full percentage rate decrease in the interest rates. That's it. I hope you guys enjoy. If you do, please don't forget to subscribe down below. Take care. Have a great day.